Go live, press the button. Okay, and we are now live. I can now turn this off. Okay, so let me go and share the screen. Okay, good morning, everyone, and welcome to another episode of the Crypto Hour. So today we'll be, as I announced before starting the session on YouTube, the session will start 45 minutes, as the AIW session will start straight afterwards at 9 o'clock UK time. So if you're not in AIW and you're interested in taking part in those sessions as well, then send me a message, let me know, and I can get you in touch with the people that look after AIW to look after you. Okay, so let me go into the economic calendar first. So this week wasn't a particularly busy week from the point of view of economic announcements. Obviously, last week was the 4th of July, so a big Independence Day, big US holiday. But this week was a little bit slow from that point of view. We have the official cash rate in New Zealand dollar that stayed at 5.5%. And the biggest thing of the week really was the inflation numbers in the US, and then there are items that are not in the economic calendar because it's not an economic event, but we had the elections in France that were kind of like a big deal this week for Europe and European-based assets. And also we got the ongoing election for the US with the television debate and what happened there, and we'll have a look at that in a minute. In terms of view of what are the numbers that determine how everything is moving at the moment, as I said to you many times before, is inflation and jobs. Okay, so this week we have two measures of inflation. CPI was yesterday, and PPI will be announced today. Okay, yesterday this reading moved the market quite substantially. Okay, and what was the reading? The reading was as inflation going down from 3.3% was like last month to 3% this month. But the important thing is that it was lower than the market expected. The market expected a reading at 3.1. I know there's only 0.1%, but it is significant because any difference from what the analysts have predicted, forces a readjustment, an immediate readjustment of the markets. And then there is a strong suspicion as well that readjustment was also used by the Bank of Japan to reinforce the yen and to force the price of the yen, up a little bit. Everybody that's dealing in currencies will know what I'm talking about and would have seen what happened yesterday. But this is significant, okay? Because what's the immediate reaction of the markets is expecting a cut in the next meeting of the Monetary Policy Committee. Okay, so the first reaction is that the yield of the government bonds, has gone down, and so this is, as I say, nothing has happened yesterday, but just to show you what that means. So this is the announcement in the yield, okay, of the 10-year bond. Okay, so in 15 minutes it went down from 4.31% to 4.18. Okay, so 0.113%, which is a lot in percentage points. Let me just show you. and this is basically continuing. If you see the charts on the left, which is the daily chart. Okay, so more long term. This is like a short term chart. So it's continuing the daily trend of the yield. The yield on the bonds going down. This is the 10-year because it's the more liquid. We'll have a look at the 20-year as well in a moment, but they all show the same thing pretty much. So with the yield that go down, the prices of the bonds goes up. So this is, I'll show you two charts that are pretty much the same thing but inverted. Okay, so this is the yield on the 20-year bonds. As you can see again, going down. There's the same structure of chart as we saw the previous one, the same effect that we had yesterday with the inflation announcements. And this is the equivalent ETF. Okay, so you see the opposite is now that the ETF, obviously, the price of the bonds goes up as the yield is going down. Okay, and this is what we are talking about. When we're talking about, it's a, when we saw this signal here in October, that institutional investors started after a long period of decline. Okay, so this has gone on. The drop in value of bonds is going on from 2020, from the pandemic. So for 4 years, basically the prices of bonds has gone down as the inflation was rampant and interest rates were going up. And then at this point here, the institutions started buying again. And this is where this green line is where I told you about it. Okay, and where you should have taken notice. So as you can see here, the green band, as price left here, was point where it would have been really good to start buying again. Okay, and this we enter into this area at during April and May, and now we have left again. Where can this get to? That it really is depending on the price, the interest rates. The more the interest rates come down, the more the price of bonds will come up. Okay, so this is where we were when the interest rates were pretty much at zero. And if you take out the craziness of the pandemic, so where we were, in 2019, this bond was at, so the price of, this is the ETF that invest in 20-year plus expiry bonds, was at 133 to 140 roughly. Okay, so compare that to where we are now, which is 93, but you see what the potential is, is for getting a kind of like an investment that can pay you a monthly interest equivalent to about, at the moment about 4.5% a year, while at the same time offering the potential, no certainty, because nothing is certain in investing. Okay, no certainty, but a very high potential of the capital value growing as well. Okay, so then the return will be a combination of the interest that you receive and the capital value. Okay, so this is the one announcement that we had this week. As I said, there is another one. This is the consumer price inflation. Today is the producer price inflation. So the cost of the goods that the producer buy before they make up the products that they then sell to the public. And the other announcements, I mean, there isn't nothing specific. This week is not a non-farm payroll week, but there is the weekly announcement about unemployment. And that has been pretty stable this week, but just continue I'll just show you the slow deterioration that we are seeing. Okay, so this is kind of like a little bit more detailed. So the inflation rate month on month even came down. So for the first, because normally when we say inflation is coming down, it doesn't mean that things are getting easier in people's pockets, because if the inflation is at 3%, it means that prices are still going up 3%. Yes, it's not as bad as price going up 6 or 7%, but it's still worse than prices not going up at all. But this month we actually saw a decline in month on month of inflation, which obviously is an effect of the economic situation at the moment. In case this I wanted to show you from this is the jobless figures. So jobless figures are actually a little bit better than expected, although the the continuing jobless claims, which is the one that I look at more than anything else, as pretty much unchanged from last week. I mean, 4,000 jobs in is not really a meaningful change. But we have to say things for what they are. So the jobs are remaining just a weekly pause so far, that the inflation rate has grown at the highest. So not inflation rate, sorry. The amount of unemployed people has actually increased to the highest amount that it has been in a long time. On here, you can see as well, these are reported as well, the Treasury bill auctions. So what's the yield on interest? And it's good to see as well how for different lengths, how the interest is performing. So it started ticking down. So you see, this is the very, very short term, like 1 month. 528 was last month, now 527. This is 8 weeks, 527.5, 526. And when we go on to the 15 and 30-year mortgage rates, then we go into kind of like a slightly better decline from 625 to 617, from 695 to 689, the 30-year mortgage rate. And this is the one that a lot of people use for the fixing their mortgages, and is now moved consistently below 7%. As also the 30-year bond auction, though, they showed like an increased demand, and it's pretty much even like a 0.02% increase, but pretty much the same as last month. Okay, now let's have a look at what happened. All of you watched the debate between Donald Trump and President Biden. Now, let me show you. First of all, let me just talk very briefly about the French elections. The French system, we were talking about the French election 2 weeks ago. And so although the right won the first round, what happened is that the parties of the center and left got together really and withdrew the weakest candidate for the second round. So instead of having, so basically what happens in France is that there is a first round where less than 10% of the members of parliament are elected, and then there is a second round where any candidate with more than 12.5% of votes participate in the second round. Now, in some occasion may be just 2 candidates, some occasion may be 3, 4, even 5. Okay, so what happened is that the other 2 strongest party withdrew their candidates. So in most places they were just like the right and 1 other candidate. Okay, they represented the center left. So in the second round, then the center left came out on top, and the right came out as the third party. So now we have in France a hung parliament that obviously it has some uncertainty for Europe in general, but at the moment is carry on as normal, basically. Okay, because there are still negotiation going on. So the two main parties, the center and left, will get together and form a minority government, and the markets are happy to carry on as normal. Okay, while that happened in Europe, in the US, we had the television debate, and you all know that now that there is a strong chance that the Democrats are going to ask President Biden to step down. Okay, so at the moment, how did the market read this? So this is sorry, these are the odds of Trump winning the elections. They are gone, like, as you can see, steeply up recently from about 50% now to almost up to 60%. and the odds of Biden winning the election are now kind of like dropped like a stone. And at the same time, the odds of Kamala Harris being elected, the vice president now have gone up now and higher than the president itself. So we'll see what happens if Biden will actually soldier through all the way to election day, or if it will be willingly or not, or if we'll be forced to step down. And then, even in that case, we don't know 100% if Kamala would be actually the candidate, or if there will be a speedy process of replacing of having another sort of primary election. I mean, it's very unlikely. So the most likely option is that if Biden steps out of the way, then Kamala Harris will be replacing him. How did the market read this? So these are just kind of like odds in the kind of betting markets of how things are seen. But this is the market implied path for Fed funds. And we can see a yield curve steepening going forward, and this goes from the current time where the yield curve is still negative to 2028. So the markets are reading. So the yield curve basically is the difference between short-term bonds and long-term bonds. Okay, at the moment that difference is negative because short-term bonds actually pay a higher interest than the long-term bonds. Normally, this is calculated 2 years against 10-year bonds. Now, why at the moment, if we let's go back for a second to the other screen. So if we look at where is my chart? If we look here, if you can see on the right-hand side, the 10-year bond pays 4.22%. So that's the yield on the 10-year bond at the moment, where the 3-month bond pays 5.39%. Okay, so if you have money and you are a bond investor, so because you want some, maybe you retired and you want some yield from your capital, etc., etc. So why would you not just buy a 3-month bond and then every 3 months just renew them as these expire? Okay, if you invest in a long-term bonds rather than a short-term bonds, whether it's a 3 months, as you can see, different expiries, pay least interest because interest rates are expected to come down. But why would you accept generally, if you take if you buy a 10-year bond rather than a 3 months, you take on a certain risk, and that risk is interest rate risk. Okay, because if interest rates go up, then your investment loses value. If interest rates go down, your investment actually gains value. So for taking that extra risk, because at the moment, as you can see, there's a negative difference. And if you take an extra risk, you would expect it to have a premium, okay, to receive a higher interest that pays you for the extra risk that you are taking. Okay, now that premium, as we're going down, it's called like a term premium. Okay, and we can see that term premium, and we can see in the next graph, is at the moment is pretty much at zero. Okay, but going forward is expected to grow from negative to about 0.2 by 2028. And this is kind of like the model of the term premium, which, as I said, at the moment is pretty much zero. But in the past, if we go back to 2014, 15, it was well over 1%. Okay, and that's the difference. That's the premium that you would expect to receive for taking a longer term risk, on like depositing your money in an investment for the long term. Now, having seen all that, and with the potential of Trump winning the election that at the moment is given is kind of a very high probability, we have to have a look at what the policies are that Trump is campaigning on. Okay, because if he wins, then obviously he would enact this policy. And there are three main things from the economic front that is talking about. One is being tough on immigration. Secondly is put heavy tariffs on imports, especially from China, to protect US businesses. And the third policy would be to put pressure on the Fed to cut rates and weaken the US dollar. Okay. Now, what would be the effect of this policy? You know, the first policy being tough on immigration, which means that there will be an upward pressure on wages. Okay, that's simple, because less people coming in, less number of workers available for any position, means that employers might, will find more competition to find workers. That means that they have to pay more. Simple. So higher wages are in itself inflation. Secondly, heavy tariffs. So blocking free trade, reducing free trades is by itself, especially in a position where with minimal growth that we have at the moment, is an inflationary policy again. And the third one, obviously, the pressure on Fed to cut rates. So if rates are cut to stimulate the economy, that is an inflationary policy as well. So all three of the main economic policies from Trump, if he gets elected, will have an inflationary effect. So what is our outlook for the future? So especially when we look at the stock market, and in general to all of what I consider like risk assets, and in this obviously we have the stock market, we have crypto as well is another risk asset. So these investments look more interesting as interest rates go down. Okay, if the interest rates stay elevated, they are less interesting simply because people have an easy way of getting the kind of the income that they need from their investments simply without taking any risks. Now, if we look at the Sharpe ratio of the S&P 500, okay, which is the main index, the main stock index in the US, it's a value of 3. Now, this probably will mean nothing to you. The Sharpe ratio is a risk-adjusted investment return. Okay, now to make some sense of it, any hedge fund manager would be ecstatic and be deemed to be doing extremely well if his investment portfolio has a Sharpe ratio above 1. Okay. And the opposite also is that we know that there are 2 biases in investing. One bias is to follow the recent trends. Okay, so there is a recency bias to do what's worked in the past month, 2 months, 3 months, and so on. And the second is to follow the herd. Okay, so both of these are seen in the current moves in the stock market. But also to be noticed that historically, so this goes all the ways to the 90s and before, levels of Sharpe ratio at 4 and above indicate a turning point for the stock market, and the start generally of a correction phase. The correction phase could last months, it could last years. But definitely what you want to be careful of is this level of the Sharpe ratio between 4 and 6, which we're not there yet, but it could be reached in a couple of months if we carry on with the current move. You say, well, what does it matter to me? Well, it matters to you if you invest in stocks and shares, because these levels are the levels at which hedge funds and investment funds will start preparing and repositioning for the bear market. Okay, so they get ready, or simply, with hedge funds, they're not tied by so many rules and regulations. They will just, try to make money from selling stocks rather than buying stocks. Okay, so this is what the institutions will turn around, and change in their models for the next few months. So this is why I'm telling you, you should take notice. Whether you do or not, it doesn't mean that, the moment that it touches 4, everything drops. It could happen before, it could happen later, it could go as far as, we've seen in the past, it's gone as far as 7. But can you see that those points are really the peaks that, there's still people buying at these points, there's still people buying up here above 6. Can you see, will that have been a good investment criteria to keep buying at these points? I don't think so at all. Okay. And so it's something to keep an eye on. And let's have a look. Let's have a look as well of, yesterday was a big day as well for stocks and shares. As you can see on the right hand side from the daily chart, we've had quite a run in 2024. Okay, so well over 20%. Actually, I think we're closer to 30%. Not in 2024, but from October, we're now 36%. Actually, we're gonna up as almost like 38. In 2024 is a little bit less. Where are we? 2024, we're still around 20%. So something like this, yes, it does look dramatic on the day, okay, because it is a big move on the day. But still, there's nothing when we look at the big picture and how stretched out we are. Now you got to remember that we are hitting pretty much almost on a daily basis new all-time highs. Okay, and this point here represented an all-time high that was hit yesterday before prices started. Exactly after the announcement. This is so just to show you what happens when and why you should stay out of the market when these things happen. So within 15 minutes, price went up and made a new high, and then it came back to where it started. And then this is like 1 hour before the opening of the market. And then when the market opened, there was again another push for the bulls to try and push higher, and then there was a collapse. Okay, and this is what we've been since now, kind of people kind of licking their wounds a little bit, and now the market is making its mind up. Okay, shall we have another go? Shall we, take our profits? So be careful. At the moment is it's a time where when prices are so high, it's a time where also protection for the downside it's really cheap. Okay, so I'm not telling you to sell anything, but definitely if you have quite an exposure in your portfolio to the stocks and share markets, you really should have an option account that at the very least just to use as an insurance. Okay, so in case things go down, or simply even if you don't have an option account, you can buy a leverage inverse ETF if you wanted to, depending on how risky you want it to be. But if you buy an inverse ETF that maybe has a 5-to-1 leverage, that means that you could, with 20%, you could cover 100% of your portfolio. So if the market goes down, your inverse ETF will gain 5 times the amount that the shares drop, so will counteract the drop of the shares, but obviously the opposite would happen if prices go up, and that would mean that your safety will be quite expensive. The option market is a lot cheaper because you only have to pay the premium rather than actually buy an asset. So with buying some put options, for example, at the moment, you could protect your the downside quite easily without having to touch your stock portfolio at all. Okay, now we have done this. Let's go and have a look at a couple of things for crypto. Crypto is being dominated at the moment by things that are not crypto at all. Something like we're talking about the ATS, we're talking about the German government that is selling in Bitcoin that confiscated. We have talked about Mt. Gox that is starting to pay back some of the Bitcoin that have been locked in there for kind of over 10 years now. So there are all things that are bringing more supply to Bitcoin. Now, one of the things I wanted to look at a couple of things right now. One of the things that we've been talking about, and you heard a lot, is like crypto uses a lot of energy. And even kind of Elon Musk, was on record saying, well, I'll start accepting Bitcoin for Tesla when Bitcoin is over 50%, Bitcoin money is over 50% sustainable, uses sustainable energy. Well, this is actually shows you that Bitcoin mining now is 55%, almost like 56% done through sustainable energy. And it's the one, if you consider Bitcoin like an industry, crypto like an industry, okay, now this is the most sustainable industry in the world by far. Okay, no other industry uses so much renewable energy as Bitcoin does. So just that this is just to counteract all of the rubbish you hear about Bitcoin uses as much energy as a small country. What you should ask, if somebody asks you that, you should ask him, okay, how much energy does the banking system use? Because Bitcoin has got no banks, it's got no tellers, so it's got nothing that needs to be powered apart from the network itself. How much does all the banks, all the banks, central banks, all the financial system, how much energy absorb? I don't think there is a calculation for all of that, but definitely, now Bitcoin mining is got together and thinking, well, look, enough of this rubbish. Let's put some real data here, and we got data now for how many sustainable energy is used. Even when it uses non-sustainable energy, obviously the miners make money by the difference what they pay for the energy and the Bitcoin they produce. So they want to pay as little as they can for the energy. So they're already using the best possible tariffs, which are the ones on when there are no peaks in energy usage. So they're using energy because energy production is 24 hours. Sometimes the energy production produces more energy than it's needed because they need to allow for peaks in demand. When that peak in demand isn't happening, then Bitcoin mining is taking up the slack. So it's actually making energy production more efficient rather than consuming energy that could be used for something else. Now, having looked at the price range, so Bitcoin has dropped a good 20% now in kind of like this month alone. And the thing is that we have seen now that not just that there has been kind of this sale of Bitcoin, but Bitcoin spot Bitcoins on exchanges and paper, that means like futures and options, have actually gone up during this month. So there is more supply, and this is what caused the price of Bitcoin to come down. From instead, if we look at the the level of spot Bitcoin and the levels of ETFs, that really hasn't changed that much. But this kind of extra supply has caused the price to decline. From the point of view of risk, though, although Bitcoin is a risk asset, it has kind of decoupled from the stocks and shares market, and although it's gone down as well in the past yesterday, it hasn't gone down as much as the stock market. And the actual risk at the moment, if you see here at the bottom, the graph at the bottom is the micro risk. The micro risk is very low. It means that at these prices, big investors are actually piling up on their Bitcoin. So they're seeing as an opportunity to buy the dip as instead of a kind of like panic selling. And the Bitcoins are getting accumulated as normal, by investors that have thousands, tens of thousands, hundreds of thousands of Bitcoin. What is commonly referred as whales. Couple more things. We look at the ETFs here. Where are we? ETFs. This flows. As you can see, there have been some outflows, but generally over the past few days, even with the price of Bitcoin declining, the ETFs inflows have gone up. So we are still maintained that over like 15.5 billion worth of Bitcoin since the inceptions of the ETF. So although the prices have gone down, the ETF has shown to be like long-term investors. And here we see, as we saw before, Grayscale Bitcoin numbers keep going down. Now BlackRock has a good 10% more than Grayscale, and again Fidelity as well is keeping its numbers up. So I would think that in the next like 5-6 months maybe we'll get to the point where Fidelity will become the second largest holder of Bitcoin ETFs. What did I have? Did I have anything else? Nothing else major to show you. So this is an article that was talking about the German. I mean, it's not German government in general. It's a Saxony government. So it's a region of Germany that confiscated a number of Bitcoin, and they have to sell them by statute. The confiscated items need to be liquidated. So this is what's happening right now. But it's showing that probably that by the end of this week, most of the coins would have been moved now to exchanges and sold on. So the extra pressure coming at least from Germany will come to an end. And we've seen that even throughout all this selling pressure, the investors, especially the ETF investors, have been undeterred and have carried on actually putting money in. Okay, so let's stop the share. Let's see if there are any questions. Say not a strong chance, Catherine, that Biden will stand down. But we'll see. We'll see what happens. You may be right. You may be right. Well, if he doesn't stand out, it's almost like a guaranteed loss, pretty much. But we'll see what happens. Any questions? We've only got a few minutes left. Eric, I can see you got your hand raised.
Yeah, you were showing the Standard & Poor, and what I learned is that there's a big percentage, some 20% in those 500 titles, is 7 titles.
Yeah.
So wouldn't it be better to look at the different index, like I learned from you the Russell 2000, which shows more the average business, not just the 7 big ones?
Yes, definitely. You're 100% right. So that's not let me just see quickly if I can show you the Russell 2000. Okay, so you can see the opposite of what happened yesterday. So we have a kind of like a disconnect between what the Russell is doing, which is again the 2,000 medium-sized companies in the US, and the Nasdaq and the S&P 500 that are mainly based on the majority of the index is dominated by a few stocks. Not even, you say 7, but even the top 3 or 4, they're so big, like Apple, Nvidia, Microsoft, they dominate, and Google dominate most of the market. So this is interesting to see that idea of lowering interest rates has actually pushed the Russell up quite a lot. So this is quite a big move for yesterday. Okay, and is the opposite of what happened in the S&P 500 and the and the Nasdaq. But one thing to notice is that while the other indexes have created new highs, the Russell is far away from it still. So it's still a good 10% below the high that was reached in November 2021. So that's the reality of, if you want to look a kind of like a picture, like a summary of the US, the actual US companies are working in the US and struggling. This shows you that over the past 2 or 3 years, haven't had a good time at all. Okay, so they're being kind of like stuck in a range for a long time. Then we're just now emerging from that range. So these are the ones that companies that struggle to get investments as well through the market, and so a lowering of interest rates with the going to the market and going to banks mainly would put them in a better position now than they were yesterday. Okay, we have a question from Kerry, and then we'll call it a day. Okay.
Morning, everybody. How are you all doing? Just two questions. The second one might be a very involved question, so maybe not necessary to answer it. Maybe I can get an answer somewhere else. But I think high level, just with all the data we've been through this morning, and thank you for that, Luca, and hope you're feeling better, by the way. Are you saying then, and I know it's never financial advice, but are you saying that essentially with everything going on, Bitcoin is still showing all the crucial fundamentals of a solid investment over time?
Yes, exactly that.
Okay, amazing. Thank you. And then my second question is with regards to a starting point to look at opening an options account, understanding options and things like that, future trading. Where's a good place to kind of start to explore that rabbit hole?
Oh, that's a long question. I mean, the easiest thing would say to go and, there are lots of, if you go to investing.com or something like this, there will be a simple explanations on what options that, but we're not talking here about option investing of using option to, we're talking about as protection, simply as, you can buy options in other direction. And the difference between, so for example, let's say a particular stock is $1,000. Okay, so if you want to invest actually in that stock, you need to have $1,000 to buy one share. Now, in options, you can just buy an option that allows you to kind of bet on that share reaching a certain level, and so you only pay a small premium to have that option because you don't need to actually exercise it. You just buy the option. The option can be exercised or can be let to expire. Okay, but the options are two ways. One is like, call options is basically expect the price to go up, and put options is expect the price to come down. Now, so they gain value when price come down. So if you at the moment, if prices are going up and you buy an option, like a put option, that increases in value, prices come down, works as an insurance. And instead of having to sell all your stocks, it means that you can buy an option that is far away from actual price, that the price for it will be very little. Okay, so for a very little investment, you can protect yourself against a 15-20% drop of the market, because in that case, yes, your your portfolio loses value, but your options gain a lot of value very quickly and counteract the the loss that you have in your portfolio. So that's the way that's the reason why I was talking about it. If you have a quite a large stock portfolio, it's not practical to buy and sell all of it at one time. So this is why people use these kind of strategies, because it allows them to leave their portfolio alone and make sure that it doesn't lose value even when we hit a big trough in price and we go through like maybe a 6 months bear market or something like this. Okay, but generally, yeah, we will need, if you're really interested in options as an investment vehicle, you will need to purchase a course from somewhere. But there are many free mini courses that will explain exactly how they work.
Thank you, Luca. That's great.
No problem. Okay, guys, so I'll need to stop it here, as just I need 10 minutes before I start the next session. We'll be back next week, and Jonathan will demonstrate for us a kind of like a few on-chain applications and things that you can do on-chain that you didn't even knew it was possible. Yeah, so no pressure, Jonathan.
I love that, so it's fine.
That's fine. And okay, so I'll see you again next Friday. And if you're part of AIW, then I'll see you in a few minutes during the other session. Okay, so see you again next week, or see you in 10 minutes. All right. Bye, everyone.